Welcome to TheoTrade. This is Don Kaufman. Here we are. It is February 6, 2017. Well, it's a Monday after the Super Bowl. It's a relatively slow trading session. We've got, just about 12 minutes left in the trading day. And when I say it's a slow trading session, what am I basing that on? Am I basing it on the fact the S&Ps have only moved 4 handles? No, I'm basing it on the fact that we've only done about 1 million S&P contracts. So a lot of traders are just waking up this morning on the Monday after the Super Bowl. They're not moving very well. But what is moving in the markets today? Specifically, I want to take a look at the bond market, and then we're actually going to talk about a strategy that I want you guys to think about in the coming days, coming weeks over here. So the bonds, they're getting it done today. They're up 1.5 points. Now, that's 1 and 17 ticks. Now, there are 32 ticks to a 1-point move inside the ZB. So, for the most part, 1 and 17 ticks, about 1.5 points move to the upside. That's fairly substantial if you look at trade inside of the ZB. Lately, we've seen some point moves, maybe even 1.5 points move. But again, we want to watch real carefully here in the days to come to see if the bonds are going to continue to the upside. For the sake of clarifying all the positions that I currently have on, I do, in fact, have a long bond position. Again, I want to make that clear. I am long bonds right now, so I'm long bonds. Short S&P, short NASDAQ, short a bunch of Russell. In fact, the short Russell happens to be one of my larger positions along with short the financials. So you better believe I'm tuned and turned on to what is going on inside of the bond market. Every rally of the bonds, I look for the XLF, which are the financials, to weaken. Now, let's get to the strategy portion of this discussion. So, looking at markets lately, the implied volatility, and however you want to gauge implied volatility, some people look at, the VIX. What is the VIX? It's the S&P 500 Volatility Index. Listen, however you want to gauge volatility, it's incredibly low. Now, yeah, some of the volatility picked up mildly today. Nevertheless, the volatility is incredibly low. And in situations like this, you got to stop and you got to tune out all the noise out there that's telling you, sell options, sell options. Listen, I grew up selling options, okay? I have sold options and made most of my career surrounding the idea and the logic of selling options. But I don't sell options when the volatility in the short duration here is 8% or 9%. And as far as the eye could see, all right, which is like 73 days out over here, we're still 13.36% volatility. I'm not selling it. I don't want anything to do with selling it. In fact, I'm actually going to talk to you about strategizing being on the buy side in the short duration. So for those of you that are interested in maybe paying a little bit more attention to markets on a day-to-day basis, we're going to go into a product like the SPX. And I'm going to make an argument here because this product, the SPX, now has 3 expirations, right? Here's a Monday expiration, a Wednesday expiration, a Friday expiration, right? Monday, Wednesday, Friday. So pretty much every day is an expiration day. You got to love it. But this really affords you an incredible opportunity to do what's called buy long gamma. Buying gamma, that's buying short duration options and looking for volatility to kind of pop wide open. Let me kind of show you what I mean over here. So this happens to be a Wednesday expiration, right? It's February 8th. And if you look at the implied volatility and what's termed the expected move, the volatility is under 8%. That's like a VIX for the next 2 days, right? So today is Monday, come Wednesday, it's a VIX for 2 days and it's like under 8%. And the entire expected move between now and what? And Wednesday? So that includes Tuesday's trade and all of Wednesday's trade. The entire expected move is $12.61. Now, it's not saying the market can't move $12.60. It can move $12.60. But if you look right now at the at-the-money options, and again, what are the at-the-money options? Well, here we are at 22.90.99, right? So the at-the-money options, buy the at-the-money call, buy the at-the-money put, okay? And they're trading for $9.35. Now, just time out here for a second. I'm going to freeze the screen. You can buy the at-the-money call and the at-the-money put for $9.35, and that will literally buy you, okay, 2 days of the market. If the market goes up, you make money. If the market sells off, you make money. This is something I've been working on a lot lately and doing quite a number of in our TheoTrade chat room. It's what I term a buy and bail straddle. What a buy and bail straddle is, if you go out and you pay $9.35, okay, for the straddle, you're like, whoa, whoa, whoa. Listen, even one contract, you could lose $935. By the way, you could also do this inside of the spiders for a fraction of that. But let's say you have $935 at risk. The only way you can lose a full $935 on this trade is if we closed at $22.90. And if we closed right there on the expiration, which happens to be none other than February 8th, which is Wednesday. I mean, the probability of closing right at $22.90, okay, without any movement up or down is like what? Almost slim to none, but it could happen. All you have to have happen inside of the next 2 days of trade, if the market, okay, for example, rallies up, you can bail out of the call side of this and you got a free ride on your puts. The buy and bail straddle, okay, what I'm trying to do is get back my $9.35 and then leave the other side on, meaning if the market rallies and I can sell these calls, okay, and I can collect at or more than $9.35 for the calls, then I got the puts still on for a free ride if the market turns around and sells off after the next day or so, okay? And it's something, again, I've been working a lot on. However, what is also plausible, you realize tomorrow, you buy this thing today, tomorrow the market could explode higher. The market explodes higher, or you wake up tomorrow, the market tanks. Guess what? You got yourself a nice free ride to the upside or to the downside. You paid $9.40 for this thing, but recognize the expected move over the next 2 days is $12.54. Okay, we have a very high likelihood of touching, okay, either side of that $12 move. In fact, you can even look. All right, for those of you that are a little bit more option geek sensitive, you can even look at the probability of touching. Okay, what the probability of touching is, well, there's a 43% chance we're going to touch 2280. On the flip side over here, okay, there's a 41% chance of touching 2300. Touch either one of those, okay, and you have yourself a profitable trade. And that's one of the most important things. And I want to expose this because, again, I like the idea right now of being on the buy side of premium as volatility is incredibly low. But this is, again, it's a little bit more of a strategy where you gotta, map this out a little bit. You're putting up some risk, and if you don't like the SPX, okay, the place you might want to employ this is possibly the spiders. Okay, the spiders are going to be what? They're 1/10 the product size, and here are the spiders. They're trading at what? 228.86 over here. You could do this with the 229 straddle. It's trading for 95 cents. Notice the relationship there. Instead of being $950 at risk, now you have, for the most part, one contract's $95 at risk. At least here you can kind of experiment without putting extraordinary risk measures in place. Instead of using, the SPX, use the spiders over here. Again, this is going to be a little bit more of a product that's friendly. However, it only has a Wednesday and a Friday expiration. So think about it a little bit. Being on the buy side of options in what is an incredibly and inherently low implied volatility, okay, in the current environment over here. Again, you're not going to get me to sell premium out there. Buying premium right now looks pretty appetizing given the fact that, come on, we're 140 character tweet away from a 5% move in this marketplace. Thanks everybody for joining us here at TheoTrade. I'm Don Kaufman. Be in the TheoTrade chat room all throughout the course of this week. Have a great evening. Bye-bye.